Hello, everyone, and welcome to SCORE Fairfield County's live webinar on running your business using financial statements. I'm Bob Hogan, the webinar coordinator today and a business mentor here at SCORE Fairfield County. I'll be your host today, and our presenter is John Harmon. More on John in just a minute, but just a few minutes on some brief information on SCORE. And John, if I could have you move the slide, please. SCORE is a nonprofit national partner of the SBA, and we offer three primary value-added services to small business owners. First of all, we offer free one-on-one mentoring, and you can access that by using the yellow bit.ly link that you see on the screen, or you can just go to our website and click on the Request a Mentor button. Secondly, we offer a wide range of educational programs, both webinars and in-person workshops, like the one we are doing today. And lastly, we offer extensive resources on our website, including access to various business tools and information. Our next live webinar will be next Tuesday, January the 30th at noon. The topic is Managing Stress with Yvonne Zuko presenting. And again, you can find more specifics on our website, fairfieldcounty.score.org. If you're on our website, we also have a large number of recorded webinars that you can access on demand, and those are on a wide range of business topics, and you can just view them at any time at your leisure. Just some logistics about today. We have set aside time for Q&A at the end of the presentation, and John will take as many as he can up until the top of the hour. If you have a question, though, you can type it in at any time using the Q&A button, which is usually at the bottom of your screen if you just run your mouse there. And lastly, we will end sharply at 1 o'clock to respect your time. The session is being recorded, and the link to the recording will be available on our website, fairfieldcounty.score.org, within the next day or so. It's now my pleasure to introduce our speaker today, John Harmon. John has been a SCORE volunteer for over 12 years, and he has also operated his own management consulting business, helping small to medium-sized businesses improve their growth and profitability. And for 10 years prior to joining SCORE, John worked for Fortune 500 companies in sales, marketing, and strategic planning. I'll now turn it over to John. John, it's all yours.
Thank you, Bob. I appreciate it. There we go. This presentation is primarily for those in business, but I think that those of you who are just starting out in a business will find it useful, if only to introduce yourself to what financial statements are and how you can set yourself up to use them. So what are the key questions that we're going to be answering today? Well, what are the key contributors to my growth and profitability? There are a bunch of metrics that we're going to talk about, bunch of concepts we're going to talk about today. Don't try to employ them all, but select a few that you think are germane and important to your business. Are my costs in line with my business model? Business models differ in terms of the amount of cost of goods sold or administrative costs that they have. So as an example, a construction company might have gross margins that are in 25% range. If you're a retail company, those margins will be closer to 50%. If you are a consulting or a software company, those margins might be as high as 70 or 75%. So some of it, your margins are based on the business model and the industry in which you are participating. How well do my assets contribute to profitability? We'll talk more about what assets are and what they mean, but clearly you want to make sure that whatever you invest in an asset, and an asset could be a piece of equipment, it could be a computer, whatever you want to invest in assets needs to show that is contributing to both revenue growth and profitability. How do I improve my cash flow? I find that many people in small business don't pay enough attention to their cash flow statement. Cash, as they say, is king. And if you don't understand what your cash position is at any particular time, you run the risk of either going into a default or having unused cash that you could use for other reasons. What are my financial risks? How do I manage them? Every business has them. The question is, how do you minimize them? You're never going to remove entirely financial risks, but you can certainly minimize them. What trade-offs should I make between financials and business strategy? There are some profitability metrics that you may want to discount in favor of investing in the growth of your business. In other words, you may want to take a loss or you may want to have lower profitability in the short term in order to get the cash and the sales to justify growth in the long term. So all of this is about business strategy and how business strategy plays into your use of your financial statements and how you develop your goals. What's the financial value of my business strategy? You could, for instance, take an income statement and play what-if games with that statement over the next 12 or 18 or 24 months. What do you think sales ought to be like? What do you think your costs might be? What this might mean in terms of your profitability and your growth? And then finally, what's my business worth? Some folks are interested in selling the business. So how do you go about determining the value of your business using financial statements? We're going to be talking about, first of all, the basics in accounting. I am not an accountant, and I don't want to drag you through the minutia of accounting, but we'll want to talk about some of the more important concepts there are in accounting and how they relate to your use of the financial statements. We'll talk about the P&L, the balance sheet, and the cash flow statements. We'll talk about how these statements interact with one another, how one flows into another, and then we'll talk about the common problems in setting up your balance sheets, your cash flow statements, and your P&L. And then we'll talk about financial ratios. There are certain ratios that are important to determine the success of your business. Don't pick them all, pick a couple that are going to be key to your belief in the growth of your company. So here we are with an income statement, a P&L. What is it? Well, it's basically a history of business transactions over some period of time. It could be a month, it could be a year, it could be a quarter, but each P&L is a statement of transactions over a period of time. It includes sales and revenues, expenses, and net profit, and we'll get into much more detail on that in subsequent slides. The balance sheet, unlike the P&L, is a snapshot, a point in time of your assets and liabilities. What are assets? What are liabilities? Assets are what you own. Liabilities are what you owe. And then finally, there's equity or net worth. And by the way, the assets add up to exactly what liabilities plus equity and net worth are. It's a definition. So one must equal the other. Assets must equal liabilities and net worth. We'll talk about more in a few minutes. And finally, the cash flow statement. What is it and how do you use it? How do you manage it? I should point out that a sale is not the same thing as getting paid. You might make a sale one day and get paid for it the next. That's what a cash flow statement's for. A positive cash flow means cash remaining for other things, which is good. Negative cash flow means cash must come from elsewhere. You don't want to have too much cash on hand because that cash can be utilized better if you use it to your effective strategy. So having too much cash, having too little cash is a problem, and your cash flow statements can help you estimate what that looks like. And then finally, the cash flow statement will track seasonality of cash accumulation. At what point during the year do you tend to be cash flow negative? At what point during the year are you cash flow positive? Counting basics. I'm going to try and be simple on this, I hope. Each time a business looks at an accounting statement, they have to decide whether they're going to be a cash or accrual accounting company. Cash accounting is simply like a checkbook. When you get the cash, you recognize it in your P&L. When you spend the cash, you recognize that expenditure in your P&L, regardless of whether you've actually made the sale or acquired the property or piece of equipment. Accrual accounting is noting that transaction when it occurs, not when you pay for it, not when you receive the cash, but when it occurs. So if I am in, say, the retail jewelry business, I make a sale on Tuesday. I send an invoice out. I get paid on Friday. I note the transaction on the sale on that Tuesday. I note the receipt of cash on a Friday. So it all depends on when that money comes in or goes out, as opposed to when the actual transaction occurs. You'll see more examples of that as we go through the slides. When do you recognize revenue and expenses? This is particularly true for accrual accounting. So if I am if I am selling pizza, say, I'm likely to get revenue and cash at the same time. And it's going to be easy for me to recognize when I get the revenue because I get the cash. On the other hand, if I am in the, say, home improvement business, that project may take weeks or months to occur. The question is, at what point do I think the job is partly done or completely done? That's to some extent a bit of a definition, but I want to try and recognize that during my reconstruction, I'll have certain phases that I'll consider to be complete. So there may be a demolition phase, in which case I'll say, okay, demolition done. I'm going to recognize the revenue associated with that demolition. There could be a refurbishment phase. There could be a painting phase. There could be a number of phases, each of which will have its own definition and its own completion. And that's when I recognize the revenue for that particular transaction, whether I get the cash or not. And the same thing for expenses. When do I recognize expenses? There's such a thing as a chart of accounts. Every accounting package has them. A chart of accounts is nothing more than a list of different kinds of revenue that you're getting or the different kinds of costs that you have. It's important that you have the right term for the right kind of revenue or the right kind of cost. An example might be marketing. It doesn't do you any good if you have just a big category called marketing, because there are lots of different kinds of marketing that you'll want to recognize expenses for. It could be website development. It could be events. It could be publications. It could be anything, but you want to try and recognize each of those expenses as in its own discrete way. Same thing with revenues. You may have different kinds of customers that have different revenues. So as an example, if I am in the retail clothing business, I may want to recognize revenue coming from a particular segment, say women as opposed to men. Or I may want to recognize revenue coming from a particular kind of clothing, like formal clothing or casual clothing. Whatever that distinction is, just make sure that you have a chart of accounts that recognize those differences in revenues. Incurring an expense versus buying an asset. Generally speaking, anything you buy that has a life of less than 12 months, you consider it to have an expense, and you chart that in your P&L. If it has a life more than 12 months, then you consider it an asset and you chart that in your balance sheet. Again, we'll talk more about this. And then finally, depreciation and amortization. Depreciation is a recognition that you have spent a certain amount of value of an asset in a particular year. So if I have a $10,000 car as an asset, and it lasts 10 years, that is, in theory, then my first year, $1,000 worth of that $10,000 car will be applied to the P&L. It's an expense. I've used up 1/10 of that asset, and the asset value in my balance sheet is going to reduce by $1,000. I'll show you examples of this, but it's important that you understand that depreciation is a cost. It's a non-cash cost, but it's a cost nonetheless. And it's something that can reduce your profit for tax purposes. You want to make sure you don't forget about it. Amortization is simply another way of looking at property, intellectual property. So if I have software, that software has a certain amount of time and I'm using that software up over a certain period of time, I want to take that as an expense. Here's a sample P&L. This is a rather crude example, but nonetheless an example. And every P&L looks roughly like this. At the top, you're going to see revenues. And those revenues need to be broken down into sales and dollars. What I usually advise my clients to do is to try to break revenues up into significant strategic pieces. So it could be you want to break your revenues either by market segments or by product types or services or whatever, but you want to make sure that you recognize certain types of revenue as discrete from others so that you can understand the growth of those revenue segments, number one, and number two, the gross margins or profitability of those revenue segments, which gets into the cost of goods sold. Cost of goods sold are the costs of directly delivering your service or your product to customers. It usually consists of materials, labor, and shipping and handling. So if I am in the if I'm in the retail jewelry business, I'll buy jewelry from a supplier. That's materials. I'll have a certain amount of labor that goes into packaging that up, shipping it out, whatever. Yeah, I need to recognize each one of those cost of goods sold because they are related to a particular transaction. If I'm in the service business, I'm not likely to have materials. It's only going to be labor and shipping and handling, perhaps. But nonetheless, the difference between revenues on one hand and cost of goods sold on the other is your gross margin. Gross margin is important. First of all, it helps you understand your basic company profitability. If your gross margins are not sufficiently high, you're unlikely to make money at all. And also those gross margins depends on the type of industry you're in. We've already mentioned that certain industries have relatively low gross margins, construction being one of them. Other industries have moderate gross margins, and that's usually retail. And others have very high gross margins. So depending upon the industry you're in, you can expect a certain gross margin percentage. Your goal, by the way, is not to turn yourself from a construction company into a software company. Your goal is to try and maximize as best you can with as little impact on the customer as possible, what your gross margins might be. So in the restaurant business, gross margins could be anywhere from 25 to 45%, depending upon how the restaurant is managed and the kind of service and customers it has. So, but understanding what the industry expectations, industry standards for your gross margins is important for you to know so that you can try and be as good as you can in improving on those gross margins. Then there are expenses. These are costs that you can't relate to a particular customer transaction. Things like salaries and wages for staff, marketing, the cost of sales, travel, other things that you can't identify with a particular transaction. And the difference between the gross margin and your expenses is called your operating profit. And that's before interest and taxes, by the way. And one of the reasons it's important to understand the operating profit is it tells you the basic profit potential, profit capability of your business before you have to pay off interest and before you have to pay off taxes. Subtracting interest and taxes from operating profit gives you your net profit, and that is the so-called bottom line. So that's the way P&Ls work, income statements work. Every P&L is going to be roughly structured as you see it here. The balance sheet. Balance sheet is typically arrayed the way it's seen here. On the left-hand side are assets. On the right-hand side are liabilities and equity, stockholders' equity. And assets, by definition, must equal the combined value of your liabilities and your equity. For people starting out, that's going to be by definition negative. You're going to have a negative liabilities and stockholders, as you can imagine, because you're just starting out. Further, the assets are divided into current and fixed. So current assets are those assets that have a value of a life of less than 12 months. That includes cash, accounts receivable, and inventory. Each one of these things is likely to last no more than 1 year. If you have cash that sit around for more than a year, you're not using your cash very well. And then there's fixed assets. These are assets that have a life of more than a year. It includes furniture, computers, trucks, office equipment, whatever. In the example I'm going to show you in this presentation, we're going to look at a catering business, and the catering business has ovens and walk-in coolers. That's one of their assets. So fixed assets, current assets, if you add them both together, you come up with total assets. By the way, notice that there is an item here for accumulated depreciation. My computers, my ovens and walk-in coolers have a certain life. I've used them up in 1 year, so that I take that as an expense. I reduce the asset value by $17,000, and I add as an expense $17,000 to my P&L. On the liability side, again, short-term and long-term. Current liabilities are those liabilities that have a life of less than 12 months. That includes accounts payable, and whatever I'm paying in a portion of a long-term debt. So I may be paying off a debt either in interest or in principal. So whatever I've paid off in that year is a current liability, and I've paid that off as I'm able to do so. Long-term liabilities are basically loans, computer, furniture, bank loans, or whatever. And the sum of total current liabilities and total long-term liabilities are total liabilities. You add that to the stockholders' equity. In this case, they have a value of $200,000 of stockholders' equity. Again, by definition, what you do is to take the asset value, subtract the total liabilities, and you come up with the net worth. And this is basically what your company is worth. If you're selling your company, the buyer is going to be very eager to know about your existing equity. It doesn't matter that much for new businesses or businesses that have no intention to sell, but it is something that needs to be recognized in your balance sheet. And then the cash flow statement. This is nothing more than a elaborate and fancy checkbook. So at the beginning of every month, I have a certain amount of cash. In this case, it's roughly $15,000. Then I have income from sales. This is cash I've received from sales, not complete sales, because I may have sales that I haven't gotten cash for yet that I've listed as accounts receivable. But so I have incoming cash, I have cash from sales, and then I have cash outflows. That would include any purchases I make, costs, expenses, salaries, wages, etc. And I subtract total cash outflows from total cash inflows. And I factor in the original cash I had to the beginning of the month. In this case, I had $24,000 of cash net, which is to say I spent more than I received. And I compare this to my $15,000 cash position at the start of the month, and I'm ending up with a negative cash balance of $9,000. That means that I got to come up with $9,000 somewhere, somehow, in cash. It could be that I have a bank account. It could be I have a rich Uncle Edgar. Doesn't make any difference. I have to come up with the cash to make that difference. And then that balance then is carried forward to the next year, next month, and so on and so forth. And you can see in this example that I'm gradually increasing my ending cash balance from negative in the first month of the year to positive by January. Now, of course, or June rather. This is just an example, and it rarely happens so neatly and quickly as this. but just gives you an idea of the use of the cash flow statement. It's important that you keep track of your cash. I have known clients who don't do that and suddenly find themselves without an answer, looking for cash that they don't have, and that's not something you don't want. Okay, so here are the three statements. You have a balance sheet that has assets that's going to help you generate sales. So I have equipment that's going to help me do that. I may have a truck or a piece of operating equipment that's going to help me do that. That's going to generate sales. That sales then is also going to require that I maintain expenses. And those expenses may very well appear on the balance sheet as a debt obligation. It could be that I don't have enough money to cover the expenses. I may have to borrow. So that's going to appear as a liability on your cash flow statement. Any uncollected sales I'm going to get needs to be registered as accounts receivable. I've done the work. I've noted that the sales in my P&L, I haven't gotten the cash. The question is, well, how much is that worth, and how big is my accounts receivable bucket? I may want to reduce my debt, in which case that's going to be cash, and that debt reduction is going to be registered in my cash, and as is any of my excuse me, cash for expenses. When I get the cash from receivables, it immediately appears in my cash flow statement. So here, these three documents are the basic working documents for any business. Generally, I recommend that clients look at their P&L every week. Less frequently your balance sheet, but just as frequently your cash flow statements. Those two, the outside, both P&L and cash flow statements, you ought to be looking at regularly, and to make sure that they're accurate and up to date. There are problems in maintaining these documents. First of all, we already mentioned this, a poorly structured chart of accounts, which is to say, I have a chart of accounts that's too big, too general for the amount of money I'm spending. So it could be that I haven't defined precisely enough my marketing, or I may not have defined precisely enough the amount of money I'm spending on payroll. To whom? Is it part-time? Is it full-time? Who is it going to? And having those labels is important for you to maintain that data. Second is inconsistent categorization of revenues and costs. You need to be consistent. You need to make sure that you consistently apply a cost of goods sold to the cost of goods category, as well as administrative expenses. Particularly if you're using a bookkeeper, you want to make sure the bookkeeper understands what item goes under what category. Doing that inconsistently makes your financial statement worthless. You can't trust the numbers. So make sure that you're consistent with that. And if you're using a bookkeeper, make sure that she or he understands exactly how to maintain those books. Failure to monitor bookkeeping entries. I have known clients who have placed an undue amount of faith in their bookkeeper. I'm not saying bookkeepers are dishonest. Bookkeepers may not understand how to maintain the books very well. You want to make sure the bookkeeper is up to date and accurate in maintaining those books. We've already talked about the insufficient revenue and profitability detail. You want to make sure that you're tracking your key balance sheet items properly. Depreciation, asset value, liabilities. Make sure that each of those is maintained up to date and accurate so that you understand your balance sheet. We're going to talk a little bit about some of the financial ratios that come out of the balance sheet, but more on that later. And then finally, insufficient management of cash flow. It's amazing how many of clients I've seen who just don't look at the cash flow statement very frequently. And doing that is a recipe for a surprise and usually failure. Okay, now we're now in to financial ratios. These are ratios you can use to understand the extent to which you are managing your profitability and your cash flow well. It also helps you understand what decisions you need to make on how you use your assets, what your expectations of profitability are, and how you use your cash. So we've already talked a little bit about gross profit. We've talked about operating profit. There's such a thing as a return on assets. So I may have an asset. My favorite example is in the pizza business, where I'm using a BMW Series 7 in order to deliver my pizzas. Well, that's a very expensive asset for the amount of revenue I can expect from that asset. So I either need to start selling a whole bunch more pizzas, or I'm likely to trade my BMW Series 7 in for a motorized bike. Who knows? But it gives you an idea of how assets can be overvalued and overused and more expensive than you need. So return on assets is an important profitability factor, as well as your fixed asset. What kind of revenue turnover do I get from my fixed asset? Return on assets is profitability. Fixed asset turnover is the extent to which my assets are able to generate revenue. Liquidity. This is largely a function of your risk, your financial risk. What kind of coverage do I have of my debt? And there are two basic ratios that allow you to do that. Both of them represent the ratio, the difference between your short-term assets and your short-term liability. And you want to make sure that your assets are higher than your liabilities. Your short-term assets are higher than your short-term liabilities. The difference between current and quick is that current ratio has to do with businesses that have inventory. Quick ratios are apply to those businesses that have no inventory, but the same idea applies. You want to make sure that you have your asset value for your short-term assets is greater than your short-term liabilities. And then finally, efficiency. How efficient am I in converting accounts receivable and payables into cash? How quickly am I able to convert inventory into cash? As I said before, pick one or two, at most three of these ratios as the ones that are most germane to your business. It may change over time, but don't try to manage your business using all these ratios. And by the way, these ratios are just a handful of the total possible ratios out there in the accounting world. And it would make us all dizzy if I got into that sort of detail. So I'm going to spare us all. Okay, so here is the profitability ratios. We've already talked about gross profit. It's the first level of profitability. It varies from industry to industry. You can Google what is the typical gross margin for the software business, or I should say supply chain business, or whatever your business is. You can Google and you can find out a standard gross margin for that business. That, by the way, doesn't mean that you have to return that gross profit figure. You may want to beat it, but at least you understand the extent to which your industry sees this as a typical gross margin. You can also use it to calculate your break-even point. So at what point do my gross margins, the dollar value of my gross margins, pay off all the other costs I have? And that's the break-even point. Operating profit, earnings before interest and taxes. Sometimes it's known as EBIT, earnings before interest and taxes. This is profits coming from your operations, not excluding payments for taxes and for interests. And it's the best descriptor of operating capability. Sometimes in some businesses, don't take into account depreciation as a part of their operating profit. This is called EBITDA, earnings before interest, taxes, depreciation, amortization. The reason they don't include depreciation in or amortization in coming up with this operating profit is because these are non-cash expenses, and they want to understand the extent to which their business is capable of generating cash as an operating profit. Net profit, that's after all expenses are deducted. Return on assets, we've talked a little bit about this. So it's my net profit divided by my total assets. It represents the asset contribution to my profitability. To what extent are my assets contributing to my profitability as listed in my P&L? And just as with gross profits, it varies widely from industry to industry. Again, you could Google what is the return on assets for the online clothing business. You could come up with some return on asset number there. It could be that you don't care about return on assets for your business for now. That's not one of the key profitability ratios that you're going to use to manage your business, but it's there nonetheless should you wish to do that. And then finally, fixed asset turnover. To what extent do your assets generate revenue? And you take your total revenues divided by total fixed assets, and you come up with the capability your business has in generating your revenue. If your assets, $1 worth of assets is generating only $1 worth of revenues, there's a problem with your assets. Either you're not using those assets wisely to generate increased income, or your assets are overvalued. They're too expensive for your business. So those are the profitabilities. There we go. So here's an example of profitability. This comes, by the way, from a real life example. This is not the actual business. These are not the actual numbers, but they're roughly right. And so what you see here is the revenue by type of event. So there are themed events and celebrations with its own revenue line. Plated events, as opposed to buffets, each has their own revenue line and the number of events that have occurred to generate those revenues. Nonprofit events and weddings. When you look down at the cost of goods sold, each one of those revenue items has a particular cost of goods sold. And you can see, by the way, that the cost of goods sold for nonprofit events is higher, much higher than it is for themed events or even weddings. And of course, your question is probably, well, if it's such a loser, why do I have nonprofit events at all? Well, the answer to that is because nonprofit events generate prospects for weddings or plated events. So you want to make sure you have enough nonprofit events to generate enough interest in your business to come up with customers for other more profitable events. So I've added up the revenues, I've subtracted the cost of goods sold, and I have a gross profit about 42%. Now, in the catering industry, this is pretty good. Catering profits, gross profits, tend to be anywhere from 35 to 45%, depending upon the type of catering you have, depending upon where you are in the country, depending upon the kind of food you serve. So the gross profit for this company is not too bad. It's 42%. Then we look at the administrative costs, and we can see that the administrative costs are almost 40% of your revenue. And when you take 42% gross profit and you subtract 40% administrative costs, you end up with an operating profit that's between 2 and 3%. That's really low. And especially if you have to pay off interest and taxes. So something in terms of the ratio, something's wrong here. Why given a healthy gross profit, why are the operating profits so low? And of course, you're probably saying to yourself, well, it's because the administrative expenses are too high. Okay. So the next question is, well, of the administrative expenses, what seem to be the highest cost? What are the biggest drag on my cost structure for administrative expenses? And it turns out salary and wages is the biggest one. Now, it could be that I have too many people and I need to lay people off. It also may be that these people are a future asset, that I need these people to generate yet more sales for my future, and I'm willing to accept lower operating profit in order to have the people necessary to generate future revenue increases. These are strategic decisions. You need to decide what you want to do, but at least you have the numbers there to tell you exactly what the current situation is and how you might want to respond to it. So that's the P&L. The balance sheet. Again, we've got current assets, fixed assets on the left-hand side, current liabilities and long-term liabilities on the right-hand side. In this case, I've got $15,000 worth of cash, $100,000 in receivables, inventory of almost 35. Well, what are my return on assets? And I'm going to take that total asset of $349,000 and I'm going to divide it into my net income, and I'm going to come away with a 0.02% return on assets. That is terrible. Why is that? Well, we'll get into that in a minute or two, but it's a bad number. And you want to make sure that when you recognize this, you understand what the fix is. On the other hand, my fixed asset turnover is pretty good. For every dollar worth of fixed asset, I'm able to generate $4 in revenue. So the question is, well, why is one number good and the other number bad? And that has to do with my utilization of assets. And we'll talk more about that in a second. But I will tell you this, that $100,000 worth of accounts receivable is $100,000 of cash you don't have. Your customer has it. You've already performed the service and you're not getting paid. So the question is, how do you reduce that number, and how can I can improve my return on assets as a result of managing that number? Measures, this is your risk measurement. This is current and quick ratios. I take my current assets, I take current liabilities and divide it into current assets, and I come up with some ratio. And your current ratio should be at least 1.5 times your current liabilities. That is, the value of my current assets should be 1.5 times higher than the value of my current liabilities as a minimum. Now, the key elements that go into my assets are going to be inventory and accounts receivable. To the extent that number is low, there may be an opportunity for me to better utilize inventory, not have as much on hand, not order as much, or how I'm able to manage my receivables. Quick ratio, again, it's the same idea as the current ratio, except there's no inventory involved. In this case, it's generally prudent to have your ratio 1-to-1. That is, your short-term assets are roughly equivalent to your short-term liabilities. This is sometimes called working capital, but whether you call it a current ratio or working capital, it's still the idea of comparing your short-term assets, excuse me, to your short-term liabilities. Pardon me. And then finally, days of cash. How many days of cash do you have on hand? And what you do is to take my cash position remember now, this is a snapshot in time. So I multiply it by 365 days in a year. We divide it into annual revenues, and we come up with a number of days of cash. Generally, pardon me, I recommend that clients have at least 30 to 60 days worth of cash. And that's because you usually have a payroll to meet, and you want to make sure that you have enough cash to meet that payroll. It also allows you a little comfort level that you have enough cash on hand to run your business. So here's an example of these various ratios. If I look at the bottom left, days of cash, I have $15,000 worth of cash available. I multiply that times 365. I divide that by the amount of revenue I have annually, and that tells me I have 6.3 days worth of cash. Not enough to cover my payroll. That's a nerve-wracking number. My current ratio, by the way, is pretty good. I have 3 to 4 times the value in short-term assets than I have in short-term liabilities. So the question is not so much current assets versus liabilities, it's how those assets are structured and the extent to which those assets are contributed to my days in cash. So another way to look at this balance sheet. And then finally, this factor has to do with just cash management. How well am I able to manage my cash? So how do I know that I have the right level of, if I have accounts receivable, what's an acceptable amount of cash receivable? And generally that's 30 days. If you can make your accounts receivable equivalent to about 30 days, that is every 30 days you're gonna be able to turn those receivables into cash, that's pretty good. If not, and I've known businesses with cash monthly receivables that are 60 and even 90 days. That's a huge amount of receivables that are sitting there and you're not getting paid. So managing this is an important part of managing your overall cash position. Days inventories outstanding, same thing. What's my average monthly inventory? I divide that by my cost of sales times 365, and I come up with the amount of active days I have in inventory. Now, this is a bit of a tricky business. You want to make sure that your inventory is sufficient so you don't stock out. On the other hand, you want to make sure that you don't have inventory that's sitting around for months and months doing nothing except sucking up the cash that you had. You want to make sure that you're managing your inventory levels. And again, you can Google this and find out what average day sales outstanding are for your inventory. Payables is the same thing. I want to make sure that I'm paying, honoring my suppliers by paying them, but don't pay them too quickly if you don't need to. Sometimes you can work out deals with suppliers so that they'll accept later payment, but you want to make sure that you don't pay off your debt too quickly. You want to make sure that you don't have too much short-term liabilities sitting there, because it does endanger your credit position. And then finally, cash conversion. I add my day sales outstanding to days inventory minus my days payable to come up with the amount of cash I have on hand at any one time. So these are the important considerations that you have in managing your business. Here's another example. So in this case, day sales outstanding, $100,000 worth of inventory. Sorry, of receivables, and that equates something over 60 days. Excuse me, worth of receivables, and that's way too much. This company, this owner needs to look very carefully at its accounts receivable. Now, managing accounts receivable has a number of factors associated with it. Number one, terms and conditions. What are your terms and conditions? If you demand payment upon receipt of the invoice, okay, that's fine. You may not get it, but at least that's your term. You may want to have 30 days end of month, which is to say, I'll give you to the end of the month plus 30 days to pay it off. Those are terms and conditions. They need to be clear. If they're not there, the customer can do whatever they want, practically speaking, because you haven't told them what your terms are. Second, is making sure that you're on top of customers. Sometimes they get busy. Sometimes they're trying to figure out how to run their business, let alone how they're going to pay off their suppliers. So a polite call could very well help you keep your accounts receivables lower. But however you do that, and I should also say, sometimes you may have a very large customer who's always a late payer, but they pay. And you don't want to lose those customers. So you're willing to accept late payment in return for their continued business because they're so big. These are all policy decisions you need to make as a business to figure out how you effectively manage your accounts receivable. Inventory, about 25 days worth of inventory available. That's not too bad. I take the amount of inventory, I divide it by my annual COGS amount, and that way I come up with a number of days of inventory. You want to try to keep that into some reasonable level, 25, 30 days. You can Google that and find out what days inventory outstanding are for your particular industry. Current liabilities are you're paying off these accounts payable pretty quickly, every 14 days. Well, you've got 60 days worth of receivables, got 14 days you're paying off payables. Something is wrong somewhere. So purely as a prudent way of managing cash, try to make a little later payment for your payables. Go after customers that are in your receivables column, and make sure that you are able to have a cash management cycle that is to your benefit. In this case, this cash conversion cycle suggests that I have 53 days worth of cash available between inventory, receivables, and payables. So how am I doing here, Bob?
We should try and get to questions as soon as you can.
Yeah. No, let's do it. Let's do it.
Okay. Do you want to wrap up at all, or?
Well, I should one final thing. This is just a cash flow inventory for the entire year. What this says is that they have $121,000 worth of negative cash for the year. And we've already talked about ways in which they could manage their cash better, both in terms of increased sales, increased gross profit, or asset management, or inventory management. And I'll leave it at that.
Okay, that's great. Okay, lots of information there, and we're now going to use the remaining time for Q&A. Just a reminder, if you could use the Q&A button and just type your question in, we'll take as many as we can up until the top of the hour. The first one we have is from John. It's when you were talking about looking up financial ratios on Google, and John's question is, if I don't trust web search results, where is another good source for looking up industry ratios?
Well, you can go to the library. The library has a number of reference documents there that can give you industry standards around gross profit, asset management. Any of the major libraries will have reference guides that will help you with that. This is data that inventories will willingly share with libraries. Not all of them, not all businesses, but some. And to give you some idea of by industry, by type of business, all the key financial ratios that you could ever want.
Okay. Next one is from Daphne. If I have two personal cars that I use for my business, not 100% each, but I track it when I drive a certain vehicle, how do I account for them in Schedule C? There's only one spot for one vehicle info, like date, place, and service, number of miles, etc. So I think the question is, she's using part of two vehicles rather than just one.
Yeah. Well, there's a number of ways you can do that. One of which is mileage. So you could simply apply the number of miles that you use for each vehicle, however many vehicles you have, and multiply that by some standard cost per mile to come up with a cost that you want to list on your Schedule C. I think that's probably the easiest way to do it. By the way, your accountant can help you with some of these details. If you have one, they can help you with depreciation rates. They can help you understand what kind of costs you can write off and what kind of costs you shouldn't write off. But it's an example of how you might want to apply that question to your particular cars.
Okay, that's great. Here's one from Jack. For a smaller business that generally doesn't need a robust financial statement, are these templates available or similar ones in Excel that can be customized and linked to other tabs with invoicing info, account balances, etc.?
Well, I'm usually a fan of buying an accounting package. QuickBooks is an example. QuickBooks offers you a PC-based version of the software. They also offer one that can run online. But these accounting packages will provide you with all the structure you need. All you need to do is to fine-tune maybe some of the chart of account listings, and then begin updating your QuickBooks with this. I do not recommend using spreadsheets because spreadsheets don't have the flexibility you need. Another value of using an accounting package is it helps manage the cash. So it can generate an invoice. It can recognize when a payment has received based on that invoice and make sure that the cash is deposited in your bank based on that invoice. So a lot of these accounting packages can help you manage all that, and they're not expensive. I think if you a QuickBooks online package, depending upon the size of business you have and the number of transactions, can run you $40 or $50 a month.
Yeah, I think that's a great advice. Just a reminder, if you do have a question, you can type it in and using the Q&A button, and we'll take. We have time for a couple more. There was one earlier, John, in the chat asking you to just while we're waiting for questions, asking you to review the definition of operating profit. Yeah, maybe you could just go over that.
Yeah. So operating profit is profit before you spend money on taxes or on debt. It is a true indication of how profitable your business is. You may have a bunch of loans out there, which are important to have, but payment for loans is unrelated to the ongoing profitability of your business. You want to make sure you understand the extent to which your business is profitable in and of itself, rather than understanding what the tax liabilities are and what your debt obligations are.
Okay, that's great. We've had a couple of questions related to the slides, and just to repeat, the webinar is being recorded, so the slides won't be sent out. But if you want to access the slides, you can go to the recording, which will be on our website under on-demand webinars within the next day or so. And I think if you registered, we'll often send a link out as well. So anyway, so you can do that. Our next live webinar is a week from today, January the 30th, and the topic is managing stress with Yvonne Zuko presenting. And again, more specifics are on our website. And if you'd like to take advantage of the free individual counseling, you can use that link that we showed at the beginning, or you just go to our website and click on Request a Mentor. And we'd really appreciate if you could fill out your evaluations that are being sent at the end. They're very helpful to us going forward. And in closing, a big thank you to John Harmon for presenting today. Great job, John.
And one final comment, Bob. When I do these seminars, I should tell you that all of it's interesting, but you can't do it alone. And I would urge you to seek out a SCORE volunteer to help you understand the detail of how you use them.
I can't agree more. Okay. Thanks, John, and thanks again to everyone for attending, and enjoy the rest of your day. Take care. Thanks a lot, John.